There's been a lot of coverage in recent weeks in the financial media on the 10-year bond yield. And I think a lot of people are wondering why this particular yield is so important. Now, the federal government issues a lot of different debt instruments called Treasuries, and they issue those at different maturities. So, for example, if it's a 1 year maturity, that bond matures or comes due 1 year from the date of issuance. Now, the 10-year bond yield, or it's sometimes called the 10-year note, that is particularly important because it is a benchmark interest rate for all sorts of other rates in the U.S. economy, particularly residential mortgages, commercial mortgages, business borrowing, and other types of loans. And because the U.S. government is still the most creditworthy entity, that yield is a floor. So if that yield is relatively high, then all other interest rates in the economy will be high as well. I think it's pretty self-explanatory why higher interest rates are going to be a drag on the economy. Now, that yield has gone up in recent days, in large part because of concerns over the U.S. fiscal situation. I would expect it to remain relatively elevated for some time, but it is a variable that I think investors need to watch, business people need to watch very closely. It's been about 4.5% in recent weeks. It's been hovering around that. But that's an important variable. Again, it drives a lot of other interest rates like mortgage rates and business loans.